Welcome to the next edition, the April edition of Market Matters. My name is Todd Jones. I'm the CIO of Gratus Capital. Thanks for joining us today. You may notice I also have feeling a little bit under the weather here, but we thought this was important to get this information out to you because we have a great special guest speaker, as we noted here, Chris Casdia, our new Chief Compliance Officer. He's going to be talking a little bit about asset protection, specifically as it relates to our custodial relationships with both Schwab and Fidelity. And, we've heard a lot of comments or requests for this information. So periodically from time to time, we do talk about these items, but we thought it'd be now is a pretty timely time to discuss this matter because of what's going on in the broader banking system. As far as agenda goes, we're going to follow a similar agenda. I have reformatted this a little bit, but we're briefly talking about the economy and recession, what's going on within the financial sector, and specifically as it relates to commercial real estate, because we do think that's a bit of a harbinger of things to come. Some macro considerations, specifically the dollar. And then we'll touch on a few items to include equities and bonds primarily, but also a little bit on the alternative side. So the first thing we're going to touch on is currency factors that are impacting markets right now. And as you might notice, there's been a lot of media stories being written right now on what they call de-dollarization, or impacts of the U.S. dollar and how that's likely to become less of a trade currency as time goes on. And I think maybe just to set some context here, what you're looking at is the U.S. dollar index. And you can see more recently that after peaking probably middle to late last year, the U.S. dollar index has come off pretty dramatically from call it 215, I think it was, down to about 101, 102. After being in a pretty stable range from about 2015 on to 2022. And one of the main points we wanted to make here is that this type of volatility within the context of currencies is definitely not out of character. The dollar index and the dollar specifically has been stronger at points in the past. And if you were to zoom this picture out, call it 40 years or so, you would see periods of time when the dollar was quite a bit stronger. But we do think, just to summarize some of our thinking on this kind of idea or concept of de-dollarization, we think that's very unlikely. And just for reference, de-dollarization just means using less and less dollars as the global trade or settlement currency globally and replacing it with something different. A lot of articles suggest that the Chinese yuan or the euro might be a viable substitute. When you look at dollars needed to transact within the global trade system, you find very, very few alternatives, to include the Chinese currency, because one of the big considerations for it to be a world reserve currency that would be using to settle trade would be, of course, liquidity. So how deep are the capital markets within the nation that's hosting the currency? At the time, China has a closed capital account, which means that they are not allowing capital to flow out of their markets, whereas the U.S. And other European nations have open capital accounts. The other would be convertibility, which means how readily available is a currency convertible into other things, currencies in particular. And the fact that the Chinese yuan is actually not convertible into every currency, it's actually because of its peg to the US dollar, I think really limits the application of the currency as a reserve currency. So that and a few other items, liquidity being another one, just lead us to believe that while it's interesting to write about or talk about, roughly 90% of all global trade is in US dollars, and we don't see that changing anytime in the near future. Maybe a few percentage points here and there, but still trivial in the grand scheme of things. Looking at the US economy, the picture has softened a little bit. I mean, I think back in January, February timeframe, what you're looking at, of course, just to set the table here, is a picture of both the services sector in purple and the manufacturing sector in orange. And just that dotted red line here indicates anything above that red line would indicate expansion. Anything below that red line indicates contraction. And what you can see here is that, the manufacturing sector, really since the middle part of last year, has been in a bit of a contraction. Services sector, which is the larger component of our economy, the largest, has been pretty resilient in an expansionary territory. Although the most recent reading for the services sector came way back down from, call it 55 in February, down to 51 in March, almost teetering on that contractionary reading. So yes, we're still technically in an expansion, but the trend is definitely lower within both segments of the economy. And I think it just suggests that, markets are preparing a bit for a recession by way of bond markets with yields going lower. And so, it's still probably a little ways off, but markets seem to be accounting for this. And I think other indicators would suggest, by the way, that it's not going to be as severe of a recession as maybe other points in time, particularly financial related things like the banking issues we had back in 2008, 2009. And speaking of the banks, I did share this slide on Market Matters a couple of weeks ago. And, what I wanted to just point out here is that, yes, there have been, banking failures in history. This chart goes back to 1980, showing the number of total bank failures by year. And, as time goes on, the numbers of failures have been lower. That does make sense to some degree because we had in sheer number of banks, a lot more banks around. There's been just a significant amount of consolidation in the banking industry over the last, call it 10 years. So that does account for the lower number of failures. But, I think having the banking issues that we did have earlier this year in March just suggests that when issues start to pop up, they tend to not go away immediately. Just think about, Bear Stearns and the lagged effect that had until the time, because that was in February of 2008. The issues with Lehman Brothers didn't pop up until September of that same year. So a full 7-month lag. And I think if you look back at other points in time, it's been, a similar experience where, the flash to bang really took some time for it to work through the system. So, all that being said, we'll start to see some evidence of how maybe the issues with Silicon Valley Bank would be impacting other banks, because next week, I believe it is, starts Q1 earnings season. And the people that lead off, or the companies that lead off the earnings season of the banks, so JP Morgan, Morgan Stanley, will all be reporting earnings over the next couple of weeks. So we'll be intently watching to see how that preview is going to unfold. Looking at, one thing we are keeping an eye on, I did share this slide with our during our private markets webcast that we had a few weeks back. But I just wanted to underscore the point here, which is, the rise in interest rates has definitely done some damage to commercial real estate. Particularly those commercial properties that are financed by banks. Banks, specifically small and medium-sized banks, are the largest lenders to the commercial real estate industry. And just to point out, how a low starting rate or low starting point for yields on properties can impact property values. This slide, this is what our new portfolio manager, Jay, pulled off a website called Green Street. But what you see here is that this is from Q4 of 21 to Q4 of 22. So this box right here. And what it shows is as what they call a cap rate, which is just the income, that kind of net operating income that comes off of the property by type. Think of it more like a kind of like a dividend yield. So for reference, in the office space, that's the light blue line. The cap rate is close to 8%. So it's kind of use that as you're getting, if you're a new investor in office right now, you're investing at an 8% cap rate. Not to say that can't go higher, because if the income drops, then of course that's when the cap rate will rise because the property value is falling. And that's more or less exactly what this chart or this table here to the right is showing, is that for this change in cap rates or yield essentially off of these property types, this would be the implied deep decline in value of each of those property types. So for office, going from, call it 6.5 to 8 meant a roughly 22% drop in office values over this period. For retail, going from 5.9, call it to 6.4, meant a 14% drop. And then what you see down here, the worst of the cases here is the property multifamily, which basically goes from 3.9 cap rate up to 5, would mean that that value of that building, just broadly speaking, would be about 33% less, just because of how property values are calculated when using a net income approach. So lots of moving values on the property side, which going back to the banking sector, means that either some banks need to write down their loans to real estate investments, or that there will be some defaults in the real estate segment as some people or property sponsors just give the keys back, essentially. That has started to happen in some of the very large institutional investor space. Blackstone, Brookfield, and others have all voluntarily defaulted on some notes. Some of those situations are a bit unique, but again, something that we're watching pretty carefully, because we would definitely want to make sure we're steering clear of some of the issues that are in front of us. Looking at some themes for 23, some of the items that you'd probably note here, they've been on there for a while. We still believe 23 is, while we've had a pretty decent start to 23 so far, up about 7% through Q1, and the S&P for equities, bonds up 3%. We still think this is emblematic of what you get in and up and approaching a turning point. So we'll see exactly how this unfolds, of course, but I think Q1 earnings season is going to be really instructive as to the way forward. The new item I put here is that there is an expectations gap that's starting to be built, whether it's in the bond market, which I'll touch on in just a moment, or the equity market, is that expectations continue to be pretty rosy or robust, whereas some of the fundamental data might suggest otherwise. So we're really trying to be mindful of this expectations gap, because of course that's where disappointment can lead to pretty big drawdowns. And so we're still making adjustments based on that. And then, going back to the comments on fixed income, again, still see a pretty marked difference between what the Fed thinks will happen in 23 and 24 with regard to rates versus the market. And, we'll talk about some implications of that. Our investment ratings really haven't changed a whole lot. We still have, a pretty positive outlook on developed international stocks. That's been pretty beneficial for us in Q1. I think international developed stocks, the EFA index, as it were, which is an index comprised of Australia, Japan, and Europe. Developed Europe was up a little bit more than the S&P, up at 8.5 or so. Some of that having to do with the currency benefit you get as an international investor if your currency is rising versus the dollar. We still have a preference, I would say, for large cap core as our primary holding, but with some other positions we've added over the last 6 months, one of them being a natural resource position, and a mid-cap position. Government bond market, we still have a pretty neutral stance on bonds, with a preference for shorter duration with how the yield curve is currently configured. The 2-year versus 10-year is still very inverted, meaning that 2-year bonds are still yielding a lot higher than the 10-year right now. And the 1-year 10-year is actually even bigger than that. We're still continuing to maintain a bit of a conservative position in the shorter parts of the yield curve. Still have no exposure to either junk bonds or preferred stock or emerging market debt. Although, again, as rates rise, we'll certainly be mindful of the opportunity those are presenting. But for right now, we just don't think the risk reward is there. And as we mentioned, we still have a positive viewpoint on broad international or alternative investments in general, whether they be private alternatives, liquid alternatives, or even things like real assets like commodities. And then this is what I was talking about with the expectations gap. So you can see I'm using the same slide that I used, just updated it through March 30th. But you can see here is that the dotted line is a chart of the S&P from the beginning of the year, and its progression, going roughly from 3850 on January 1st to ending the quarter at 4050, call it. The problem though is that earnings, which are on this left-hand side scale, have declined almost the entire way. So while it's good that the market has been resilient in the face of declining earnings, stocks generally follow earnings over intermediate and long term, because it'd be impossible for the stock market to go up without a commensurate rise in earnings. So we'll definitely need to be flipping or watching to see any upturn in the earnings profile, because right now, as you'll see on the second slide, all that's happened with the market so far this year has been valuations, or the price, or the price that we're paying for stocks has gone up, meaning that one way to assess that valuation judgment is using the forward PE ratio, and that just relates the price divided by the earnings you're receiving. And the higher the PE ratio, the more risk, in our opinion, that you take. The lower the PE ratio generally means it's a lower risk proposition, because it just takes less time to earn your investment back. And what you can see here is the S&P has rallied, or at least the valuation multiple has risen from, call it about 16.7, 17 to over 18.5. A bit more so on the growth side, going from 23 and some change over to about 25. Value stocks have gone up in valuation a little bit less aggressively, which is good, because that's where we have, at least on our dividend driven strategies, a lot of exposure there. Mid cap actually hasn't changed at all, which is one reason why we still continue to find mid cap really relatively attractive through all this, because they're trading at not only a discount to the S&P, which rarely happens, but the valuation multiple hasn't changed. And then, of course, EM and international have changed a little bit, but still nicely discounted to the S&P. So we just wanted to share this because, again, going back to what's driving stocks at the moment can be an ephemeral source of demand for equities, meaning that the multiple is rising. And that just sets up for a bit of a disappointment in the case that the earnings don't show up later. So we'll have to just wait and see how that evolves. Looking at the bond market, this is a chart we've shown, probably 2 or 3 times over the last 6 months. But what you're seeing here is a chart that shows a number of different things. One is the Fed funds rate. So the yellow line here is the Fed funds rate and how that's evolved over the last, call it 4 years. The black line here is the 10-year Treasury yield. So this is all through April 10th. It shows where the 10-year bond is right now, roughly right around 3.5, 3.4. And then what you have is the SOFR curve. It's the overnight. It's a kind of the replacement for Fed funds rate. It's kind of like a Fed funds curve, if you will, into the future. It's trying to predict Fed funds. And what you can see here is, and then the purple dots are the plot of what the Fed fund governors believe, where the Fed fund governors believe the Fed funds rate is going to be at the end of 23, at the end of 24, end of 25, and then longer term. And then what you can see here is, while the SOFR curve is actually getting pretty close to, and Fed funds are getting pretty close to where the market thinks 23 is going to end. There's a wide range of outcomes, however, for 24, with the central tendency being well far away of where the SOFR curve is. And then 25, the market kind of settles into, kind of the thinking of the Fed. And then longer term, however, interestingly, the market believes that the Fed's going to be a little too optimistic about where Fed funds can go. So all we're saying here is, let's not get too rosy about where interest rates are going to go. There's still a lot of dissonance within these numbers. And in that dissonance, you can have short periods of very drastic moves. Not to say we're forecasting that per se, but just we have to be a little bit more careful within the bond market. And I don't have a slide on alternatives, but things that have been working for us over the last few quarters continue to work. Still like to find opportunities where there are strategies that benefit from volatility. So option-based strategies, as some of you know, have been very successful for us more recently. But we'll talk a little bit more on that at our next update, because I think we'll have some nice data sets to pull apart. So just a few key takeaways here. One of our thoughts here is that 23 rally so far hasn't really been rooted in the fundamental picture. It's been more in the flow picture. And because of that, I think we have to stay a bit more conservative than we normally would as we're approaching what could be an air pocket in the earnings sector and earnings for stocks. So staying conservative and primarily U.S. large cap and mid cap companies is where we're going to be. We still favor alternatives over bonds, because there are strategies that are benefiting quite nicely right now, liquid and illiquid. As volatility kind of works its way through the bond market and the stock market. And then private markets, I just wanted to point out, we can't really say much on this webcast. We talked about it at length on our private markets update a couple of weeks ago. But there's going to be some really great opportunities, just not right now in areas like real estate or even private equity. We're still trying to be as conservative as we can within those areas and getting more aggressive when things open up. So in areas like the credit markets or strategies that are financing real estate, for one, as banks pull back, that's an area we've been spending a lot of time on because the rates of return are pretty substantial for some of the risks that you're taking. So with that, let's talk about our special topic. We've invited on, as I said, Chris Casdia, who is our Chief Compliance Officer. He joined Gratus, I believe it's been 5 or 6 months ago. So with that, Chris, thank you for joining us today, and I'll leave it to you for this section that we wanted to talk about, which was asset protection and our custodial partners. So maybe if you could just spend a little bit of time on this slide that you put together here, and then we can open up for any Q&A after that, if that sounds all right.
Thank you very much, Todd. Yes, every now and then we get a question from a client, something like, hey, what happens to my money if Schwab goes out of business? Valid question and timely, given what happened with Silicon Valley maybe a month ago. There's 3 components to asset protection and safety that I want to talk about today. First 2 are pretty simple, self-explanatory, and the third one is a little more involved. Probably spend a little more time there. So if in the event Schwab or Fidelity were to fail, the first line of defense for our clients is SIPC. Most people have probably heard of the Securities Investor Protection Corp. The acronym is SIPC. This is in place, which covers client accounts for up to $500,000 in value. And for SIPC to kick in and provide coverage, 2 things have to happen. The brokerage firm has to fail, and client assets have to go missing. So if those 2 things happen, the first line of defense, we have up to $500,000 in protection. If that is not enough to recover the lost assets in your account, firms purchase additional insurance called excess SIPC coverage that kicks in after SIPC is exhausted. So for Fidelity, they've purchased a $1 billion policy, and Schwab has an aggregate of $600 million in coverage that will kick in and help recoup losses after SIPC is exhausted. So these 2 things are nice. Everybody should be happy that they're there in place in the event a firm fails. The third leg of this coverage is really the heart of protection, and this is the SEC's customer protection rule. This rule is sacrosanct. At a brokerage firm, a lot of time, effort, and resources are devoted to compliance with this rule. And as I mentioned before SIPC kicks in, the firm has to fail and assets have to be missing. Well, the SEC customer protection rule is there to make sure that assets are never missing. So the essence of this rule is that a brokerage firm is going to have to segregate client assets from the firm assets. And this is done so that all client assets are protected and not available to creditors in the event that a firm fails. So how do they do that? How do they segregate assets? So here's how they do it with cash. All customer cash assets are held in a special reserve account at a custodian bank, separate and distinct from the firm. Any client who's wired money to their Schwab account sees that to send the wire, it's got to go to Citibank. Or if you have a Fidelity account, the money gets wired to JP Morgan. And the reason is these are custodian banks that hold client cash assets. And then the obvious question that comes up, what happens if Citibank fails, or what happens if JP Morgan fails? At these banks, these special reserve accounts are segregated from JP Morgan's assets or Citi's assets. So in the event there's a failure there, these assets are not commingled. They're separate. So your cash is always segregated in a special reserve account for the benefit of customers. Then we get to your securities, your IBMs, your Home Depot, your Merck that you see on your Schwab or Fidelity statement. All these securities are held separately at DTCC. This is an acronym for the Depository Trust and Clearing Corporation. So while it might appear on your Schwab or Fidelity statement, your stocks are really at DTCC, held separate from the Schwab or Fidelity assets. So this is how they comply with the customer protection rule. All assets are segregated so they can never be attached by a creditor. I saw a question earlier in the chat. The question is, how safe is our uninsured money being temporarily stored at Schwab? I think I answered that question. When you have cash at Schwab, cash on deposit, it's really sitting in a special reserve account at a custodian bank.
The other question was, are banks offering high rate CDs more likely to fail as they did during the S&L crisis? I think the other way to phrase that would be, are riskier banks maybe offering a higher rate of yield on CDs than lower risk banks? And I think that's absolutely the case, where there are some maybe smaller or regional banks that have to pay investors much higher rates on CDs than call it JP Morgan or Wells Fargo. And that's actually one of the problems that US Treasury, Janet Yellen, and the Fed are all trying to solve for right now is, do they blanket cover every deposit? Currently, that's not being contemplated. But that's one solution that I've heard being kicked around as a possibility at some point. We just don't know. Chris, one of the questions that you and I were talking about as right before we got on was, are there any examples of when investor protections had to be invoked, or how these programs worked during periods of other stressful situations for banks?
Sure. Prime example that most people heard of, if you had any money in the stock market back during the financial crisis of 2008, is Lehman Brothers went bankrupt, went out of business. No customer lost any money. Now, obviously, the value of the stocks went down, but no customer lost their stocks. And this is due to the customer protection rule.
Very good. And I think there was another example that we had talked about. Did you want to mention what happened to MF Global, or is that kind of outside the scope of what we're talking about here?
A little outside the scope, because MF Global was a failure of a commodity broker back in 2011. So different regulatory regime. Yes, there were some customer assets that were lost in that one, but it was not under the SEC customer protection rule. They're under the NFA and the CFTC, just a different regulatory regime. But yeah, that was one where commodity clients did lose some money when that firm failed. But I'm not aware of any broker dealer failing since SIPC 50 years ago. SIPC was created. That's about 50 years ago, early 70s. And the customer protection rules, since these are in place, I'm not aware of any brokerage firm customer that's lost any securities as a result of a failure.
Very good.
I'm hoping to provide some peace of mind for all of our clients. We're in a very regulated business. This is the most important rule. A lot of attention is paid to protection of assets and segregation of assets. So people should feel good about having their money at Schwab or Fidelity or TD Ameritrade, and that in the rare event that something bad happened and they failed, our assets are still going to be safe.
Right. And I think, also part of the reason why we have decided to make the business partnership case with both Schwab and Fidelity. Number one, they're the two largest institutions in the custodial asset space.
Right.
The second is, and correct me if I'm wrong, Chris, but their business practices are some of the most conservative relative to maybe a larger bank. Like they don't have an investment bank in either case. They have no commodities brokerage or dealer. Right. They don't do any commercial real estate lending of any sort that's significant, at least when I looked at their financial statements. So, all those things together, at least from our perspective, and I'm sure yours as well, would indicate that these are, very sound financial institutions that are some of the most conservatively run in the U.S. wealth management space.
Right. Totally agree. Absolutely.
It looks like someone was pointing out that Bank OZK has a large offering with a 5% rate on a CD. And I think that's exactly right, because Bank OZK, as you may know, was one of the largest, if not the largest, regional commercial real estate lender. And the fact that they've got, a quote unquote, an outsized yield on their CD is not necessarily too surprising, because they are probably ground zero of what's going on within CRE loan and real estate issues at the moment. So they will be a bit of a canary in the coal mine to see how they weather this looks like it'd be a little bit of a downturn in CRE, commercial real estate. Thank you so much for spending some time with us here on Market Matters.
Absolutely. Thank you.
Peace of mind. And thanks everybody for joining. We'll certainly be in touch next time during next month. If there are any topics like this that Chris covered that you would want to learn more about, please feel free to send those into your advisor. I'll see if I can put some information together just like this, like we did today, and get you out the relevant info that you're looking for. So have a great afternoon. We'll talk to everyone again soon. Thanks.